What's up, everyone? Welcome back. Good afternoon. Vant and Rant, episode number 585. And it's, surprise, surprise. The market's down. Pretty close to lows. But there was actually a bunch of Forex headlines that came out today. I guess currency news that came out today. A bunch of currency news that came out that really just, it was a batshit crazy Forex market today. I am still in my trade. It's just kind of really slow today. Hasn't really violated any structure, still kind of moving in its direction. So very slow day for me today, but I am in the green so far. But what's up, Mike? How is your day after Fed?
Enderwigan, what's going on, buddy? What's up, Mark? What's up, Michael? Desire, Chris, Mal. Hey, happy day after Fed day.
Yeah, happy
right?
Indeed.
Happy to the day after Fed to the rest of the world day. Yeah, you can now live your life. Powell, the clown show that is Jerome Powell, is done. We had great trading yesterday during the show. Thanks everybody that kind of popped in and contributed yesterday in the extra long show. Probably go a little bit shorter today because we're tired. But anyhow, if you guys have been following us for at least the last year, I think you've had a pretty good game plan for how to handle this. I mean, we've been talking about heading to new lows for how long, Ty?
Yeah.
Okay. We've been talking about watching rates for how long? We've been talking about look at the VIX. We've been talking look at the volume, the percentage of volume. I mean, you can go right down the list, and it's been a great game plan for navigating what is really turning out to be some difficult markets. And I'm thinking, kind of readjusting some things. I'm thinking it's going to be a difficult couple years going forward. I'm thinking we could have, traders don't understand, but we can have this extended period of just horrible market action.
Yeah.
I mean, it could go on for 2-3 years.
Yeah, I mean, I don't think we'll actually be back to normal until inflation's stable, energy's fixed, and, the world stops fucking fussing and fighting. So it's going to be a while. I mean, look, we're going to be at 4% rates until even inflation's even get in touch. So we still got a lot of pain in front of us, I think. So it's just...
Yeah, and let's face it, the Fed did exactly what we kind of thought they would do, right? I mean, Powell gave you the map at Jackson Hole. It's not like some great revelation. And matter of fact, when he started his speech with the press conference, he's like, nothing's changed since Jackson Hole.
Right.
So whatever you hear from me, I mean, sometimes it's so funny, man. Sometimes it's like the bulls are like, man, we're going, right? It's dovish. No, he had to come out and basically make sure he didn't do what he did in June. And we'll get into we'll get into the Fed, and we'll get into what's happening and what they did and what they surprised with, what maybe they didn't surprise with. But it's crazy out there. I mean, Euro stock 600 is at 22 lows already. I mean, you look at our markets, we're heading to 22 lows. Okay. Yeah. I think we're headed personally to 340, 350 maybe 360, but we'll see. We've got a couple stomping grounds in there and stuff like that. But I want to kind of pull up a couple things. Okay. I want to pull up a couple things because there is a couple, so we are, you get the question, are we getting oversold? Okay. Because I'm getting that a lot, some messages, oh, we're getting oversold, yada, yada, yada. And, one of the things they point to is, sentiment, right? And we point to sentiment. Okay. And if you look here, the AAII bears, well, they're back up to 60 here. And you can see, this is from Sentiment Trader. Every time that sentiment has gotten tilted so bearish, okay, you kind of get a nice little pop down. Now, if you're wondering where we were in June, before we had that nice little pop up, a little bounce, we were at 59 0.3. Okay, so, but what I want to kind of point here is in 2008, look where we went, right? As far as sentiment, okay? And we were still going down. Look where we went in, back in the 90s. So sentiment in a bear market can definitely get way oversold. Then, of course, if you look at the advanced decline line and you look at the cumulative line where we are, we're back to where we were in June before we had a nice little rally out of here as far as sentiment's concerned. So trying to give a little bit of food to the bull's tie before we go in and just take away their lunch. Is that okay?
Yeah, that's nice of you. I mean, not like, I mean, look, I look at the bigger picture on the monthly, on the weekly, and, if you look at the highest time from the monthly, we're sitting at, as far as being oversold, we're sitting at 50%. I mean, of the RSI, which is an overbought, oversold indicator. So if you want to go based off of volume and the strength of the move, back in 2008, they hit 20 in the RSI before they bottomed. We're at 50 on the monthly. So I mean, it's just I don't think we're even close as far as price action being concerned to being oversold.
Yeah, I mean, you could see right here what Tyler's talking about, where we were and where we eventually bottomed out. Where we are now, if you're kind of looking and kind of equating that, we're kind of right here.
Yeah, exactly. Right when
That's a great point, Ty. So I want everybody to look at this chart. This is 2008. This is where we really are right here in this red bar, okay, trying to come down, back down to lows. And matter of fact, there's a bunch of, Michael, Mott Capital, all them, a lot of them overlaid the 2008 chart to this year's chart. It looks exactly the same, right? So if you're looking where we are in this cycle, we're right here. I would argue this red bar is what we're kind of experiencing in here.
Yeah.
And you got a lot more to go.
Right.
So great point out there. And then, the other thing is if you want to go and let's look at the weekly chart of the SPY, and I see these people drawing trend lines, from the low to here, blah, 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 blah. Okay. You can't look. I mean, look where you are in the weekly. Right here.
Yeah, broken.
Yeah, I mean it's if you're trying to get your touches, which radar in here, this is where we're at. We're broken, and we haven't even gotten down. Haven't even gotten down to 200 on the weekly. So SPY's got a lot more to go. Market's got a lot more to go. A lot more pain induced possibly ahead. If you look at the daily chart, which I find interesting on the SPY here, we are, and I'll do that when we get to the Qs. But look, we've broken all these trend lines. We've broken this target zone. Big, massive bar down. We've broken the maze lows. We're now, this is the last line of defense is 372.50 on the SPY, Ty.
Yep.
That's the last line of defense in here before we just, we start our ascent down. So you can see just straight down and right off where we were at the 200 to now, we are down about 14%. Okay. So we're 14% off. And if you go to the 4-hour chart, what are you looking at here, Tyler?
Yeah, really exactly what you were looking at is we're now heading into that area, really the line in the sand point, where we had a lot of rejection before. And the fact that we, broke below that 3,900 area that we talked about, had a retest, had a double retest, and then dumped. It's just, it's having a tough time finding buyers in these levels here. And if you can't find buyers, at 3,900, if you can't find buyers at the 380, then it's just, it's just weak. And so it's going to need a lot more than just a rally to really fundamentally break through all of this selling pressure that we've been seeing. So it just seems weak.
Yeah, absolutely. And it is weak, and it can get a lot weaker, Don't forget, though, would I be short in here? No. Personally, I'm not ready to go in short. I think, we could get a little bit of bounce out of here. We did short today, obviously, and we'll kind of get through the trades. But, look at the 15-minute, we're below the 5 EMA. If you look at the intraday chart, we tried to peak above VWAP 1, 2, 3 times. Now we're back down to this pre-market low, which has kind of been, to me, I said this was going to be a battleground today because if you look at the ES, this was my target zone of where we were going. We lose this low, lose this level, then, all bets are off. So pretty sad looking action right there. Tech, the interesting thing about tech, Ty, is if you look here, the Qs are at 279. They're 6 points away from the low. Yep. Okay, what's that percentage? Give me that percentage. 6 points away from the low. Okay, because I'm going to give you a reason for that.
The percent is
what? That they're off the low.
3.5%.
3.5%. Okay, now they're 54 points from the high when everybody was saying we're going to all-time high. Okay, so what percent are they off the highs?
Off the most recent run, about 19%.
So they're about 19-20% off of their highs, and yet they're only 3% away from their lows. Okay, so that kind of puts you in a perspective of how fast we've come back down, and how close we are to just really capitulating and getting down there. And I'm not even a poor word choice as far as capitulation because we haven't seen that. It's just crazy. And then, of course, we talked about the tips, right? We told you right here. You remember right in here, Ty?
Oh, yeah.
Like right in here, what do we say? It's going back to resolve itself. Is this rocket science? No. Do we have voodoo magic, Ty? No.
Only Nick.
Okay. All we can do, only Nick has the crystal ball and the voodoo magic. No. What are we looking at? We're looking at it how it has resolved itself every single time that we had a divergence. Every single time. So that's pretty good odds. You look at small caps, trying to play catch up as best they can here because they were holding up a little bit better, but they're now in catch up mode. So giving us a nice leg down. And by the way, Ty, the Dow is only like 200, 300 some points away from its low.
Yep.
We're talking not even 1% away from reaching their low. So, very close, very close. And why? Because look at rates. Ty, look at this chart. If you saw this chart and you didn't know anything else and what time frame you're in, what's this chart tell you?
Dude,
well, stocks now have a problem, okay? Because I think the dividend, I forget what it was. I had it yesterday. It was 2.1%, or no, it's 1.8%, I think it is. Okay, and you look here, and you can get 3.7. Well, actually, you go to the 2-year, and I can get myself on the 2-year 4.3%, 4.4%, guaranteed back by the government. Why am I investing in stocks? Because at some point, when bond yields start rising, that's what happens. And we told you what would happen yesterday is that if the Fed carries that forward through the dot plot and really hammers home at that guidance, you're going to start seeing now the long end of the curve start playing catch up. And again, that becomes a problem for stocks because now you have an alternative to stocks at some point. So rates definitely becoming a big issue in there as far as that's concerned. The other thing is, the Fed, we didn't really get a chance because we were trading and all this stuff to really go through what the Fed, said and did. Well, let's take a look at that, Ty. Here's the dot plot from yesterday, okay? And a couple things to take away from this dot plot here, okay? The first thing I'm taking away is the median interest rate for 2022 is right here. What's that? 4.25 to 4.5. That is 1.25% away, and we have 2 more Fed meetings. So what are they telling us, Ty?
We're getting Yeah,
we're getting more.
Yeah, 75 and 50, or
Yeah, we're getting 75 probably in November, unless something happens there. We're getting 50 in December, and then if you look here at the dot plot for 23, we're getting another 25 to 50 basis points coming in February. So this is not a positive environment for stocks. This is not even a positive environment for the economy. And you can see they added in here. We told you this would happen. The 25 forecast, which is important. Now they also came out with their SOP, their statement of projections. And if you look here, the things I'm kind of taking out from here is look what they give us as far as GDP growth in 22. A whopping 0.2%.
That's incredible.
Okay, they started out, by the way, they started out in March, at 2.8%. June projection is right here, 1.7%. Now they're down to 0.2%. These are people that evidently aren't pretty good at figuring out what the economy is going to do. Okay, I mean, just crazy. And then if you look at 23, 1.2%, all of 23, 24, 1.7, and 25, 1.8. So I know Mal's in the chat, and I know Mark's in there. That's Mark. I saw you talk a couple times about stocks being a book value and stuff like that. Look, first off, contrary to popular belief with the bulls, we are in a bear market, and book value goes out the window, If you go back and look at 2008, I should have pulled this up. I'll pull it up for next week. The percentage of stocks that were trading below book value, I mean, it can go high, So just because a stock may be trading below book value doesn't mean that it won't go down further and won't get cheaper or possibly won't go out of business, Have a default risk. But when you see a growth rate of 0.2% GDP, you see a 1.2%, 1.7, 1.8. So, Mal, tell me, drop it in the chat if you're still listening. What's that going to do to the earnings per share, for S&P 500 companies? Where's the earnings per share going to go?
Yeah, down.
So I just showed you the Fed's horrible at predicting this crap. They always overshoot. They're only predicting 1.2, 1.7, 1.8. By the way, on the low end, you're usually looking 3 to 4%. So what that's telling you guys is that the market, where it's priced today, let's pull up the SPY. Where it's priced today has a lot farther. You're probably talking about 280 on the SPY. If these numbers actually come to fruition, and that filters through to earnings per share, because earnings per share has a correlation to GDP, has a correlation to the companies, which has a correlation to the stock market. We're extremely overvalued, and if the Fed is throwing out these type of growth numbers comparatively speaking, to where the market's pricing in value now, this market, there's no limit to where this market can go on the downside over the longer period of time. Now, couple that with every single time, I saw this stat, which I thought was interesting. Every single time that we've had 5% or more inflation, it is taken at least 10 years to get it back to 2%. 10 years. Where are we at today? 8%?
Yeah.
10 years to get back to 2%. So I don't dispute the narrative. I don't dispute the narrative that we're probably going to see headline inflation come down, But what we're not going to see is the core come down, because 40% of the core is rents, and rents right now are sticky. They're still going up at a lower rate, but I mean, if 40% of your index, look, it's not coming down. So you may see a situation where I think the market's going to be switching away, Tyler, from the inflation outlook. They're always going to look at inflation, but I think they're going to start focusing more on I'm started focusing on the labor market. Because if you listen to Jerome Powell speak, if you went through the statement, labor market was mentioned several different times. So for me, I'm more importantly going to be watching what's happening in the labor market to see if that frees up. And by the way, if you look at, the Fed projection of inflation, they had projected to come in at 5.4 at the end of the year, 2.8, and then 2.3 and 2. So, and I think that's overly rosy. But you can see here as far as where they see the core coming in, and PCE is what they typically look at. But what I also want to say is the unemployment rate, they see it going up to 4.4, which if that happens, you're going to have 1 million people lose their job. So that's what that pretty much correlates to, about 1 million people losing their jobs. So this Fed statement that we got was extremely hawkish. The projections were extremely hawkish to me. And, you're seeing a reaction that, the market, I think, is finally getting to its thick head that, hey, the Fed's not going to bail us out. Now, does that mean, do I believe that the Fed's going to stick to that narrative all the way through the end of the year? I don't think so at all. But, the market has a historical horrible time at projecting rates, okay? And so really, to me, as far as when the Fed's going to cut, they always jump the gun. And I think they've jumped the gun here. And I think more importantly that we are going to see towards the back end of the year the Fed pivot. I do believe that. And I do think we'll get some kind of temporary bounces and stuff. At least I hope so, because if the Fed sticks to the plan that they talked about, then, the markets, you're not going to want to see where we think the markets are going to go. So that's my analysis out of that yesterday, Ty. What about you? I mean, do you have anything different that you were looking at from what you saw from Big Daddy Powell?
No, you pretty much covered my analysis on we pretty much have the same viewpoint. I have some more viewpoints to bring out, not from Fed, but from other events that came out today. So I'll cover that in a little bit. But yeah, I mean, you pretty much covered everything that I was thinking about as well, as far as the Fed goes.
Yeah, and Bornholm, I did see that. So the reverse repo, actually yesterday, we got this number. The reverse repo, and I had it written down, and I see your numbers in there. I just want to make sure. Yeah, 2.2 trillion yesterday, which is not good for reserve balances. So that you should expect off those reverse repo numbers, you should expect to see the banks kind of get hit today, and the banks are getting hit. So that's not a good analysis. Look, Tamimo, my bullish analysis going forward is we're going to have pockets of strength here and there. I really do. The question's going to be for me, okay, the next Fed meeting is in November. I think it's like 2nd and 3rd or something like that. Don't quote me on that. But we also happen to have, that's like the week before or that week of the midterm election. So the only question to me is Big Daddy Powell going to be pressured into pivoting based off of the current administration need going into the election cycle. But I think, what we've been talking about is still the same. I mean, their narrative is market needs to go down. If you listen to Powell yesterday, he said the housing market is going to crash, is going to be readjusted. And he also said that, we're going to have pain, which is code word for recession. I mean, look, we're so close to having 3 negative quarter prints of GDP, for crying out loud. I was told that 4 straight negative quarter GDP prints is a depression. But, that was when I was back in college. But, who knows there. Anyhow, that's my analysis, Ty. I'm curious to hear what you have to say because, we're seeing a lot of things in the dollar and my question on the dollar is because I know what you're going to talk about. You're going to talk about, I'm assuming, the Japan intervention, Forex intervention, and it's great if you can kind of explain why that matters to us.
Yeah.
And wouldn't that really, the dollar, if they didn't have that intervention, wouldn't the dollar be so much higher?
Yeah. Yeah, without a doubt. Without a doubt. I mean, so with the intervention, look, so for those of you, I'm sure you guys all saw, but for those of you who don't know, basically they came out and said, look, we're going to intervene in the market and we're going to start purchasing yen and selling dollars. And so that's their way of intervening. Now, the problem is, and that's all well and good in the short term, right? So now you saw the dollar fall off on that. You're seeing USD yen fell off on that. So the yen's picking up strength a little bit. However, in order for this to really sustain itself, you need really all the central banks to participate. And it's just the Bank of Japan that's participating in this. And so, yes, it might slow down the pace of depreciation in the yen, but they've already said that they're not changing their yield curve control. They're not changing their QQE. They're not changing their forward guidance, the next 2 to 3 years. So they're not doing anything different. They're not raising rates. They're still purchasing unlimited amount of bonds. So they're still doing everything the same, except all they're doing now is buying some yen to try to, I guess, help the depreciation of the yen. So yeah, it might slow down the pace of how quick the dollar's going to rise from here. It might put a little bit of weight on the dollar here, but I don't think that it gives you any reason for a reversal in the entire market unless you get other central banks to help, unless you get the US, unless you get Europe and you get Canada. Unless if you get more people helping intervene and propping up, which they're not, by the way, then then it's a different story and you might get sustained. But the last I think they did it 2 other times. I think the last 2 times they did it, it worked for like a week or 2, and then it just failed. So it's gonna be the same story.
Right.
Nothing really changes here, and I think that's why you're seeing the dollar here. It's holding up, but it's if the yen didn't come out and intervene, the dollar would be soaring right now, because you have the Bank of Bank of England came out and raised their rates only 50 basis point. Very mixed bag out there. They are on so many different pages. They had half the people vote for 100, a little over half vote for 50, and then 1 vote for 25. So nobody in the world knows what's going on in England. But
me neither.
Yeah, right. But so basically, they don't really know what they're doing over there, and so it was priced in that they were doing 75 basis points. They did 50, and so if the yen didn't intervene, dollar would be soaring right now. But they did intervene, or they didn't yet, but they announced their intervention, and you won't know how much they're going to buy until I think September 30th. So we won't know for like another week, but it's not going to, it might change things for like a week or 2, but it's not going to really change anything overall fundamentally. So I still think the dollar works its way up to 115, 114, but it might work its way slower. I don't know the pace. It might pull back, retest some things, chop around for a while, but this is not going to cause the dollar to just fall apart. Or this is not going to be the top of the dollar because the yen's intervening. It doesn't change anything. So, want to put that out there. Looking at the dollar here, though, look, I mean, it's actually holding up its breakout pretty nicely. It closed very strong yesterday. Today it came down, retested that breakout based off of the yen intervention, and now we're actually dip buying off that 111 breakout, and we're pushing up towards highs. And so now, it's potentially heading back down, creating a lower high. I don't know what's going to happen the rest of the day. If we break 110.60, then we're probably getting a nice pullback down to 109. And we might be chopping around for a little bit because of the yen.
Right.
However, it should remain above 108, 109 area. It might chop around in this zone for a while, but once the yen intervention starts like being exposed in the market and it's already like out there and it's priced in, then is when you start seeing that continued dollar ramp up. So that, in my eyes, that might be the only case for the bulls on the market, is if the dollar stops soaring here and we get a extended pullback and consolidation here, but not going to be a long lasting one. That's for sure. So
yeah, look, at some point the dollar trade's got to pause.
Right.
At some point, right? The bond trade, the TLT trade's got to eventually take hold. But the problem is, it's kind of like what Mal was saying when he's talking to Mark, is where do you find that, and how do you know you found it?
Yeah, exactly. And so with the dollar pausing potentially, if you look back at what we were talking about and what Mike showed you on the SPY back in 2008 here, this is potentially where we're sitting at right now, currently in the market. And so you see the next 2 months as we're sitting at low was the consolidation phase. Maybe it's not 2 months worth, but maybe this is where now the market consolidates at lows here while the dollar holds off. I don't think it's going to be a 2-month consolidation like this was, but I do think that this could potentially cause a consolidation in the market here at this 375, 370 area here. But obviously we'll see. But that's just a case. That's a case for the bulls potentially if this happens.
Right.
Looking at gold, gold and oil have been the easiest traders the last couple of days, and it's been so easy because they've just been range trading. And all you got to do is sell at resistance, buy back down support. It's been the easiest traders. And oil, same thing today. I called out a short earlier in Discord right here, and it just went right back down to lows. I called that out in my show as well. I said if it reaches 86, we'll take shorts and we'll look for a push back down to lows. And lo and behold, that's what you got. So oil sitting here, any consolidation, range trading. Obviously we're getting a ton of resistance here at 86, a lot of wicks. The dollar maybe pausing could give you a little bit of a bullish tilt on oil here, but the fact that oil's still struggling and still not breaking out doesn't really make me feel like there's any buyers in the oil market right now, and we're going to sit in consolidation for a while in this area.
Doesn't give you a warm and fuzzy, does it?
No, doesn't make me warm and fuzzy. So yeah, oil most likely staying in this range here. Gold, again, just chilling in this range. It's been just rejecting the same levels. So until it breaks out one way or the other, I don't think we go anywhere. Looking at 4 hour though, 4 hour kind of tells me that gold might be heading down. If you look at the overall resistance here at 1675, you had a nice 4 hour break above, really strong close above, and you had a 4 hour close right back below that resistance. And so this right here is a nice fake out potentially to the upside. And typically after you get that fake out, 80% of the time it continues back down the other way and then it continues lower. Now, I don't know how much move it'll have in it if the dollar does pause here, because that means that we might have a little bit of a rally in gold. But technically looking at it here, I think we at least get a push back down to support here, 1660. So temporarily you should have a nice short in gold. However, looking at this consolidation here, if we do break back through 1675, we could get a nice rally back to 1700. If we break below 1660, then 1644 and 1618 is in play. But right now, it's tough to say because we've been in this range. Pound yen at Euro JPY, it's just, there were some fucking crazy moves if you were trading the yen or if you're trading the pound. I mean, it moves obnoxiously today. I didn't trade it because it was pretty freaking crazy. I mean, it moves, and it moves, let's see, 500 pips in one day, and it usually moves like maybe 150. So it was a fat move today based off of the pound rate decision, which was dovish, and the yen intervention, which beat down the pound even more. So looking like a pretty weak pound yen right now. Probably going to get a continuation lower. And Bitcoin last, but definitely least. Bitcoin, yeah, it's yeah.
Mal loves Bitcoin. You can't shit on Bitcoin yet.
No. I mean, like, I mean, yeah. I have no bullish case for anybody for Bitcoin. I don't think it goes anywhere. I mean, it might chop around. It might not. I don't think it goes up or down. It just feels to me that Bitcoin right now is consolidating and hugging this 19,666 level that I've had drawn, which was the previous breakout high back in like 2018 and 2020 or whatever it was. And so, yeah, just probably going to hang out here for a while like everything else, like the dollar, maybe like gold, maybe like oil. So a lot of still accumulation in these markets. But that's it for me. I'm going to give it back to you.
Good stuff. Good stuff. I feel like I learned something. All right. Yeah, I mean, look, market's trying to rally off lows, just very anemic type of rally. My problem is that the VIX really hasn't gone in. I mean, to me.
Right.
I mean, look. I mean, look back. Back in June, when we kind of rallied off of the bottoms, look where the VIX was. It was up in mid-30s. Back in May, mid-30s. Mid-30s. I mean, the best we could do during the Fed was push it through 30. So the problem I have, if you start seeing the VIX, I did think we did have the highest implied volatility going into a Fed meeting, other than the June meeting. So I thought maybe we can get a rally, going into the end of the week if you start seeing that implied volatility fall off. So that's what I'll be kind of looking for. If you're looking for a rally, I'm looking at the VIX right now to kind of, figure in. I'm looking at rates, obviously. But the put call ratio, it's not very extreme. And with the VIX kind of hanging in here, I don't know. I just don't see the push for any kind of push out of there. I mean, the NASDAQ 100 has 16% of the stocks above their 200 moving average. Okay, I think that's what it was. Yeah. So, I don't know. It's just crazy. It's crazy. But if you look at the asset, I mean, if you look at financials, I mean, regional banks kind of holding up better than the XLF, I think, but still off today. You got XLF off, as you would expect, after the hawkish Fed meeting, and then also after what you got with the reverse repos. You got XBI saying risk off. You got, look at semiconductors. Semiconductors yesterday before the Fed, that was the tell for me. That was the tell for me completely. I mean, semiconductors tried to rally. And so I told our group today, our mentorship group, watch semiconductors. If we're going to get a bounce, you're going to see it in the semiconductor group first, possibly. And just completely, just dead right there, right? Doesn't look good at all. I mean, look at NVIDIA. I mean, those of you trying to convince me to buy NVIDIA up here at 180, 200, I mean, I told you we'd probably get below 100 in here, and it looks like we may get there.
Yeah.
So definitely not looking good. I mean, look at retail, Ty. Retail not looking good. So I don't know. Yeah, and if you look at the VIX of the VIX, just very, very, very calm. Look where we were in June when we rallied. Okay, you don't see any of that stuff going on. So yeah, can we get a nice little oversold bounce? Absolutely, but I don't see any massive rally coming out of these levels yet. Just not seeing it. And we're also getting rumblings. Did you see the Credit Suisse news? I mean, it almost reminded me of a precursor of a Lehman Brothers.
No.
I mean, Credit Suisse basically called an emergency meeting of investors. They need to go for a capital call and talked about leaving the United States market completely.
Really?
So yeah, I mean, just crazy, just crazy. So, you're going to see more of that. And to answer Mark's question of, well, why wouldn't you just buy a company that's below its tangible or book value and hold? And the answer is obvious, because not only can it go down, it can go out of business. There's something called bankruptcy. Is there something called bankruptcy, Ty?
Yeah.
I think we talked about that before, didn't we? And what happens in every bear market? What happens when you get massive legs down and earnings start falling apart? You have delinquencies going up dramatically. So I know you guys, you retail traders, you're used to seeing bankrupt companies trade, but that's typically not the way it works. Okay. So, you know, just. So, Mo, real quick before I get into my stuff, he wanted me to look at TXRH, Texas Roadhouse, sell.
Yeah.
I'm saying sell just because, I mean, if the economy's going in for a recession, this thing has not fallen back at all. Yeah. Now, this is actually a better chart. This is monthly chart. I mean, tell me what you think, your analysis on it, Ty. This has actually held up a lot better than a lot of stocks.
Yeah, it's held up, but you know, I'm saying sell as well, for a couple reasons. And you know, first reason, last month you had a nice big fat rejection wick at this previous area that was notably the strongest area on the chart here. Big fat rejection. Current one already retested some of this wick and is now pushing bearish. If you hop to the weekly.
Hop.
Yeah, just hop over there.
Fucking bunny.
Weekly chart.
Look what we missed.
Exactly.
This trade.
That's
right
exactly what I had drawn. So, if you see it break this area right here, then it's definitely coming right back down to 200 at least. And so, I don't like it here. It looks like it's this right here is a fake breakout of this trend line and of these highs, and to just to grab liquidity, squeeze out of here, and then it's going to dump right back down. So I don't like it. I like it as a sell.
Awesome. So Mark says there is, if it's a blue chip company and it's making profits, then I'm really not worried about that type of company.
Oh, okay.
Let's kind of talk about that. And let me see. Okay. So Mark, let's talk about that. Cisco, blue chip company back in 2000. If you bought Cisco right here, which is where we really are in this market sell-off, $65 back in 2000. Okay. First off, where was it in a year or two later? $7. Just got back to that level back in March.
Yeah, 20 years later.
Never. 20 years later. 20 years later. This is a blue chip stock, is Cisco. Let me show you another blue chip stock. Since we got the theory, we're going to buy blue chip stocks. Okay. Where is this one? Is this Microsoft? No, not Microsoft. I wasn't looking for Microsoft. What am I looking for? Hold on. Oh, what was that? No. Yeah, it was AT&T. Okay. AT&T. Would you consider AT&T a blue chip stock?
Yeah.
Okay. Well, look at AT&T. Okay. Where it was right in here, okay, $36 a share. Where's it at now, Ty? 16. Okay. So
22 years
I don't
later.
know about you. Huh?
No, 22 years later.
I don't know about you. I don't want to buy these. Okay. I don't want to buy and just sit in some of these stocks. But that's where some of these stocks are that, you know, I mean, look where Apple is now. Okay. Look where Microsoft is now. Blue chip companies. Okay. You're going to buy here. And then if they fall down here, you're going to wait 20 years till it gets back up here. That's my point. So
Right.
I don't know. I don't know. It's there's opportunity cost and stuff like that. So I'm just I'm not really big into that. But you do you. And if you're an investor, maybe a little bit different story. Maybe a little bit different story. So we had some trades today, Ty, and our trade list. I'm gonna obviously start off the best one, and I saw Enderwigan bring it up. Yeah, we had Sava on our list today. Look at Sava today, Ty.
Yeah. Wow.
Okay, so nice trader in Sava. This was on our morning list with our mentorship group. Tyler, how many times have we seen this pattern?
Yep.
Maybe 100. Okay. I mean, look, and you missed the breakout there, gave you an opportunity here, gave you an opportunity here. Yeah, Sava, just a beast. So, yeah, we caught Sava. We've been trading Sava all throughout the week. So, nice one in Sava. Another one that we had on our list was Netflix. It's hanging in there. I mean, nice little dip buy in here. Look at this nice reversal. Would have got you some points coming out of the gate. So that was on our list this morning. We also had Hood on our list this morning. It looks like they're going to allow pay for gain. As far as the SEC and these guys. Sorry about that. Can't spell. I thought it was going to go. I actually was long this stock today, Ty. I was actually up in it, and then I got out because the market was just not doing its thing. And this is why you get out.
Yep.
Just look where it went. All the way back down this shitville stock. So it was a short-term trade. Didn't work out. So had a loss into that. And then what else did we have on our list? Oh, I had this one on our list this morning, Ty. SPRO. So this one's up 176%. How about those out? So again, opportunity. I didn't trade this, so FYI. I did trade I did trade the Hood loss, but it was a small loss. But if you look here, nice run up out of this one that was on our pre-market bet. So if you guys were watching that, pretty nice trade out of the gate on that one. Did very well. Also had Tesla on our list. Not really doing anything. Kind of maybe had its day back below the 200. Fine support. So this one is pretty much done. Probably going to take this off our list right now, and I would be careful on that one. We do have LTHM on our list, and this is one to kind of watch going forward as it's falling and breaking the 21. Just like with the solars. You see the solars today? So you got the solar stocks starting to come off, and still holding its 21, but this looks like an ugly candle. What do you think, Ty?
Yeah, no, that's ugly. Yeah.
And you got stocks. You got to start looking at the sectors that have been leading us. And you got EMPH. Look at the candle on EMPH back through this line.
Yep.
So these stocks for me now are done, especially with the type of market we're in.
Agreed.
You're seeing leadership in these stocks breaking down. That's why we get out of stocks when they break the 21. For an extended period in here. So we're done. It was a nice active sequence all the way up here, but these stocks, I'd be very careful about, being in these stocks. First, solar's still hanging up, but I would be exiting those stocks going forward. Another one that's on our list today was Frey. Actually got traded, actually got going a little bit off the dip buy if you were around to catch it. I wasn't. So, kind of came down into this level. I kind of liked that it found support in here. It would have been a nice dip buy if you were able to catch it. But again, I had no interest in catching those stocks. CELH, another one of those that we've been holding that's been doing really well. Well, now it looks like a head and shoulders pattern.
Yep.
So, this one's coming down, and it's just crazy. Yeah. So, anyhow, I was just looking at the Mo's question. Yeah. I mean, people pulling their house off the market because, the rental market, right? Well, why not rent then? If nobody's going to buy your house, why not just rent it?
Right.
Some a-hole that's going to pay 20% more. So, I mean, look, the housing market's got it's just in the beginning stages of its decline. So I think we're going to see it a little bit more. But from a stock standpoint, so there's some stocks that we've been trading, some stocks we've been following that I think it's time to start repositioning, start looking other places. And so, maybe start looking into the shorts, finishing up. Look what ARK's doing, Ty. Poor Cathie. She now looks like she's getting ready to head down for lows. So you want to be careful in here, some of these stocks. Now, I think you are seeing Microsoft was up today, just barely. Apple was kind of strong a little bit earlier. Yeah, now, and I think, of course, I think our resident bull Mark was saying Meta, but, don't get sucked into these.
I know, and Mark's got to be fucking with us.
What?
That Meta's looking good.
Well, I mean, look, guys, I always say traders make things so complicated, right? Get back down to the basics. If you saw a chart like this, does this look like a chart you want to buy?
Why the hell would I want to buy that?
Okay. Does this look like, take away this? I mean, if you see this chart in here before the breakout, does this look like a better chart that you may want to buy? Absolutely. Right? So there's a reason bad charts get worse. Okay. I mean, look at this happening chart.
Yeah.
Okay. If you want to, here's my analogy of Facebook and Meta, where you want to go. Facebook's right here. Does this not? All right. Let me ask you something. I should did a little strategy. But hold on. I want to show you something. Okay. I'm going to see. This should really hit home. Okay, so I'm going to zoom in. See, I did that. Now I can't find it. Anyhow, tell me, this area right here, does this look like Facebook? The Meta. Right here. Just stop right here. Okay? I'm going to pull up Meta. Tell me that side of that chart doesn't look like where Meta is now.
Yeah.
Does it not? You got the gap down. You got the run up, try to get into the gap, and then the slow fade off. So look at PayPal. Okay, you got the gap down, you got the run up, try to fill the gap, and then it falls off and it's breaking. So Meta is right here. And look, they even gave you the same upswing that you think you're going to get. Right? So Meta is where PayPal was at 176, and it still went down another 50%. Okay.
Oh, man.
I don't care. Look, okay, Mal's going to yell at me. I don't care about PE when I see a chart like that.
Yeah.
Okay. You know why I don't care about PE when in a stock like Meta? Because they've lost their way. When you have poor leadership, you have no direction. The company has no idea who they are anymore. They tried to change and go about face. That's why the chart's the way it is. And I'm not saying, look, nobody has a crystal ball except for Nick. Okay? And so I'm not saying that Meta is guaranteed to do this. Right? But I'm also saying there's a good chance this is what. Don't get sucked into thinking, oh, well, look, it's got to go up from here. It's got a great value. It can do this. And then you're looking like this. You're like, fuck, I got in here. Looked good to me. And now I'm down here. Boy, don't I wish I was there. So, again, hopefully Meta does well. I don't have a horse in the race. But it just looks so much like PayPal in the beginning stages. So just be careful. All I'm saying is be careful. And obviously, Mark, we are rooting for you if you're trading Meta. We want Meta to go up, but I just don't see it happening soon. Hope. Anyhow. Finishing up, I wanted to kind of go over ES. I want to go over the ES trades that we had today. I wanted to recap. Look, we had, again, great call outs, great trading that we had in this on the ES during the Fed meeting. And when you have these levels being created, now these levels get fast forward, going forward. So these levels, kind of mark them off because, this 39.25, this 39.55 levels, if we ever get a rally back up, are going to become important levels on the upside. Now, if we kind of zoom in here, And I'm sorry, let me okay. So, Ty, here we are. What do you? Nice, this pre-market level right in here. Nice low level, right?
Yeah.
Market level.
Yeah.
That 835 level, didn't I say that was going to be an important level?
Yep.
Got rejected pre-market. So what you had was you had a range, extension range in the pre-market from here to here. Okay, pretty nice wide range. So the stock market opens. We had this 3,800 level as our over-under line. They tried, the bulls tried. What happened? They failed. Bears got back in control, came back down, retested the lower end of this range. Okay, and by the way, this highlighted area here was my target yesterday, is how low we should go ultimately in the SPY. If you look at the show, and where do we go overnight time? Right to here, right? And look where we are, how this level has become so important in this area here. So the the Bears came back down, retested, found some buyers, but right now they can't even, the bulls can't even get us back up towards or even above 3,800. We're in the lower end of this range. So to me, this tells me that the Bears are in control, and you know, I'm not really ready to put on big bullish positions yet. Now, if we rally, I want to see us get back above the 3,800 level. Then I'll have some kind of maybe happiness that maybe the bulls can start mounting something. But that's my analysis rating here. What do you think, Ty?
No, 100%. I mean, I'm the same way. I mean, I couldn't have said it any better myself. I mean, 3,800 is really the line in the sand for bull bear. You know, it's like the neutral point, and so anywhere below or above it is where I want to play. So, no, I'm with you on that.
Yeah. So that's kind of how I'm looking at. You know, we had some nice trades. We had a nice little short off of this 3,800 level. You know, we had a nice little dip buy down here as we first came back into this area. So really, we were just playing the extremes of these levels, and that's kind of how I like to play it. I think that's the safe way to kind of play it right now. Not looking really for too many breakouts, but just looking for some steady trading in here. So I kind of like that kind of angle I was going after. And that's about it. Oh, by the way, I did want to bring up, well, if Cathie Wood is retiring, she's probably going out of business. I didn't hear that.
No, but the only thing I saw was she was stepping down from the role of portfolio manager on two of the company's ETFs. So she's not really retiring or anything. It's just...
Well, eventually, that's what happens when the inflows stop coming in. And I'm sure people just keep on putting inflows in and they keep on losing money. I mean, it's got to stop at some point, right?
Yeah. Yep.
I mean, I don't know. Well, I did want to finish up real quick, and we're pretty much done looking at stocks. I did want to say a couple of things. One is Kramer said that the 2-year security is the most overbought security he's ever seen. Okay, which means the 2-year rate is going to 6%. So just letting you know, I just wanted to kind of, it's like, you know, kind of put that out there. But that's it, man. I'm pretty much, I think that's it. The only other thing I wanted to show you was high yield growth, you know, was down at lows. Kind of watch a little bit of what's going on here. We're back down by lows here. Actually, you know, we're kind of making new lows. Watch credit spreads, because if you're going to get a Fed pivot, it's going to happen because of credit spreads. And look at the investment grade high compared to high yield. That's pretty surprising.
Yeah, way ahead of it.
So you would usually see it the other way around. So that's kind of surprising to me. But yeah, and I saw Mal kind of bring up debt. That is another thing that's going to be a big thing. But we'll talk about that next week, because I got a lot more into that. But, you know, if you want to pivot and you want to see, because Mo kind of asked me, well, what is your bullish case scenario? Well, if you start to see credit spreads widening, you start to see defaults go up, and you start to see bond market liquidity just disappear, and it's very tight now. then I think you could see maybe the Fed would have to step in. 'Cause those are things that the Fed will have to step in. The stock market, the economy, the Fed's not stepping in on that. They've made that clear. But if you have credit spreads widen, then what happens is basic blue chip companies cannot effectuate business. They can't borrow cash. Cash markets have in effect frozen, and the Fed's going to have to pivot to do something on that. So for me, the bullish case scenario for me is that, look at credit spreads, look at defaults, look at the bond market liquidity, okay? That's all going to be important to me going forward.
Yeah. Cool.
That's my
Awesome.
bullish case.
Awesome. Well, I think we'll end it there, guys. Thanks for tuning in, everybody. I appreciate the chat. It's been fun. Have a good weekend.
Have a good weekend, guys. We'll be in Discord, obviously, but have a good weekend and enjoy yourself. This market is just
enjoy yourself this weekend and take a breath now that Fed's over. So
ugly. Yeah, Fed's over.
Awesome. So thanks, Andrew Wiggin. I'm glad we're helping out. That's really our goal, is to just provide as much help and value as we can. So I appreciate the kind words.
Yeah, appreciate it a lot, Andrew Wiggin. Good stuff, man.
All right, guys. Have a good one. Have a good weekend, and we'll see you later.